Assalamu alaikum wa rahmatullahi wa barakatuh. Good afternoon, everyone, and welcome to our strategic investor.
Sorry, I think we have a connectivity issue, so maybe John, you would like to introduce the webinar?
Audience, it's wonderful to be here with you. You'll all see Layla from the Saudi Exchange in the frame. We've had problems with connections. These things happen even in our wonderful virtual world. A warm welcome on behalf of the Middle East IR Association, your professional body in the region, as well as our host, the Saudi Exchange. Now, bear with us. Of course, it's wonderful to have speakers with us. It's wonderful to have an audience. There is a Q&A facility. If for some reason the intermittent problems with sound continue and I disappear, I've instructed our wonderful panel to just carry on the discussion, which of course is part of the IR Essentials series we've been running with the Saudi Exchange and talks about a very important topic. And if I may start with a quote from a famous Irish playwright, the greatest problem with communication is the illusion it has already been accomplished. In many ways, through thick and thin over the past 18 months, I think that all registers with you as IR officers. And what we're going to explore today with the help of some experts is what exactly what we might expect in the coming year. If I can turn to our speakers, I'm going to start with your peer, your IRO on the ground, Ghida Obeid. Excuse me if I've not got your name perfect, Ghida. I've practiced very hard, but I'm not a linguist. And I can say to you, good people in the audience, that she comes with a fantastic background, a regulatory background, a buy and sell side background, and of course, now head of investor relations at a fashion retailer. And I'm going to let her tell us a bit more about that fashion retailer in due course. I can then turn to a good friend of mine, Michael Chojnacki, who is emerging markets guru in my mind. I've known Michael for many years. He seems to fly in and out of emerging markets. He's always got a point of view on anything and everything IR related, and it's never quite what I expect. So I'm expecting Michael, who incidentally is the founder of Mira, to have lots to say in a very exciting manner. And last but not least, I'm going to turn to Matthew O'Keefe, who I've also known for a long time. And he is our international IR strategic advisor, former sell-side analyst, very well known in the City of London for a long, long time, but now advising companies like yours, not just in Europe, but also in the Middle East. Before I ask Matthew to say some introductory remarks, I'll welcome Layla. Layla, we lost you, so our apologies. I don't know if you want to just jump in and say a few words now.
I was just going to introduce the subject of today and our speakers. I do apologize for the technical difficulties we're having today. So as my colleague John Gullifer from Mira have addressed, our esteemed speakers, Ghida, Matthew, and Michael will be addressing strategic communication in times of crisis, in particular post-COVID-19, and what we've learned in the past 18 to 24 months, what have changed, what remained the same, and how can we make the most of new platforms and channels to effectively engage with in person and online with the investment community. Again, welcome everyone, and we're glad to have you all with us. And I'll hand it off again back to you, John, our moderator, and thank you.
Super, Layla, and great to have you on board. And as I said, dear audience, there is a Q&A facility. Do get involved. Do take the opportunity to ask questions of us, and we'll try and get round to all those questions. And if for whatever reason, as I said, there's intermittent interruption with sound or anything else, our speakers will just press on as we've agreed. So Matthew, I started with that quote from the great Irish playwright talking about the greatest problem with communication is the illusion it has already been accomplished. And I think in the past 18 months, we've learned so many lessons. And what I'm hoping you're going to share with us is your perspective from where you sit, looking at international markets, looking at our emerging markets, and share with us what you see in terms of trends and what we might be thinking about in terms of our own planning in investor relations when we think strategic communications. Matthew.
Yeah, thank you, John, for that kind introduction. And it's always good to start with a quote from an Irish playwright. So thank you for that as well. It's been a really strange 18 months, hasn't it? I think we can all agree on that. 4 trends that I think I'll just touch on briefly now. And I find myself, people who know me will tell you I'm quite an optimistic person, but I'm gloomy about at least 3 of the 4 trends, I should say. And the 4 things I'll just touch on now in these opening remarks are the ongoing battle between active and passive, or the rise of passive, if you want to call it that, the rise of ESG. I will also touch on, I'll talk about MiFID II, which is maybe more of a big deal in London than it is in your part of the world. And then finally, I'll talk about M&A. But just to talk about each one of those, the last 18 months have been very disappointing for active, I think. We reached that dreadful moment in 2019 when active funds finally overtook, passive funds finally overtook active funds in the USA, the biggest capital market in the world. In other words, there was more money as of 2019 being managed by robots and algorithms than by human beings, which is obviously very bad news for anyone who works in the investor relations business. Now, if ever there were a time to reverse that trend, you would like to have thought that it would have been during the last 18 months, given the extraordinary volatility that we've seen in the market. I mean, this, in theory, would be a time when active fund managers could have sold their cyclical stocks, bought gold, bought government bonds, and let the passive funds underperform as the stocks fell, and enjoy a period of robust performance themselves. It hasn't happened. We haven't had the renaissance in active management that I think many people were hoping for. I think the best we can say is that the march of passive seems to have come to a halt, at least for now. And where we go next is a very interesting question. But I think it's absolutely existential for the IR community. I mean, if we're to have a future in any kind of world where we are advising investors, we better hope that those investors be other human beings rather than faceless algorithms. So that's a trend, I think, where life has been a little bit disappointing for the last 18 months. On the second trend, ESG, I'll probably be a bit controversial here. Most IR events I go to, people eulogize about ESG and present it as the future of the IR industry. I absolutely don't see it that way. I'm speaking in a personal capacity here, but from a personal point of view, I think these may be the 3 most typed letters that I've ever come across working in finance, and I worked through the .com boom, so I do remember other bubbles. But listen, ESG is a fact of today's world. There are clearly investors who care a lot about it. There are clearly companies who care a lot about it. But I think it is overdone, and I think there are reasonable grounds for caution on both the corporate side and on the institutional side. Just briefly on the institutional side, you'll often be told doing your job that 30 or even 40% of the world's assets under management are subject to ESG screening. I would draw your attention to the numbers. Morningstar last year identified 500 new ESG funds. 250 new ESG funds, though, had simply changed the name on the tin. In other words, many of at least a third of the funds that were launched last year were repurposed vehicles. So my suspicion is that over the next couple of years, as due diligence gets tighter and people look harder for greenwashing, we may see some almighty backlash in terms of mis-selling scandals, of which DWS is possibly only the first. So I am wary of the numbers that are commonly quoted for the size of the ESG pool of capital, and I think that you should be as well. And a simple anecdotal test that any IR officer can do is to say, how many ESG questions do we get on an earnings call? Is it really 30 or 40%, which is what one might expect if the ESG universe was as big as some people say it is, or is it maybe 1 or 2 questions or 10%? That's institutional side. On the corporate side, again, very interesting piece in the Wall Street Journal a few months ago about the statement of purpose, which was signed 2 years ago, the US board roundtable statement of purpose. 140 companies signed up to this, and this was intended to be the great unveiling of the new stakeholder capitalism era. My sense, and the sense of the Wall Street Journal, is that it's an idea that appeals to CEOs, but more in theory than in practice. In fact, what the Wall Street Journal suggests is that many CEOs like the idea of stakeholder capitalism and ESG because it allows them a welcome distraction from the world of investor relations. And that's an understandable position. A lot of CEOs do not like being held accountable to the 29-year-old guy at BlackRock who calls them at 5 o'clock on a Friday evening. They don't like that. And the promise of stakeholder capitalism is that you can invoke other important constituencies. So the irony here, as presented by the Wall Street Journal, is that where stakeholder capitalism was considered to be a move to broaden the accountability of companies to different constituencies outside of the narrow shareholder base, in fact, it's actually an attempt to narrow it and to concentrate shareholder power, sorry, CEO power, I should say. And the best evidence for that the Wall Street Journal provides is that of the 140 companies, so 180, who signed the Business Roundtable Statement of Purpose, only one bothered taking it to the board for approval. So it is more a piece of rhetoric than anything that's actually changed the way that companies are doing business. So anyway, I'm looking at the time here. I hope I'm not using up too much of my allocated time. But I would say to anyone, any IR officer working out how much of their time they should be allocating to ESG, I would think give it some pause for thought, because there are reasonable grounds for thinking this might be at least a bubble that might shrink to more manageable proportions at some stage. I'll just touch quickly on the two other things I promised to talk about. MiFID II has been a disaster in London. I'm aware it hasn't fully come to emerging markets yet around the world. I suspect that it will, because the big US funds are adopting it. But on the sell side of things, just from a personal point of view, I worked as a sell side analyst for 20 years. I know almost no one at my age now who's still left writing equity research, and a lot of talent has fled the market. And from a professional point of view, we at FTI Consulting, where I work, we look after 140 clients. It's a long list. When I started, we had an average of 8 analysts per company. We're now down to 5 or 6. So we've really seen the coverage tail away, particularly with smaller companies. So that's an acute worry, I think. Buy side are doing much more things on their own. I'll talk about that maybe a little bit later. I think it's worked well for big buy side who can afford their own analysts. I think it's worked quite badly for small buy side houses. And I'll give you a few pointers later as to what I think IROs can do to address that. Finally, on M&A, I think this is actually a very exciting development for the IR community. The world has been on hold for the last year to some extent. Companies have had to raise cash, they've cut costs, they've paused in capital expenditure. Company balance sheets are in great shape now. And as long as this economic upturn continues, I think there will be a wave of ongoing mergers and acquisitions. And I think almost nobody in the company is as well equipped as you, the investor relations officers, to give a considered view to the boardroom on how well received or badly received a particular acquisition might be. So my thinking is this is a potentially obvious and exciting add-on to the remit of any IR officer. And I'm sure that a lot of you are going to find yourselves dragged into all manner of exciting transactions over the next 18 months. So that's it really. I find myself a little bit gloomy on MiFID and ESG and the rise of the robots in passive investing, but I think M&A is an exciting prospect for all of us, and I hope I haven't spoken too much at this stage.
No, not at all, Matthew. And I'm also hoping that the audience is hearing everything that we're saying. As sort of flagged, I've certainly had sound in and out. So if you are having problems with sound at all, anybody, just let Alethea know. There's a Q&A facility. Just drop her a note just so that we're aware. I'm assuming all the speakers heard everything Matthew just said. And if so, put your fingers or thumbs up, guys, if you heard everything. I didn't. Okay, well, that's very pleasing. So we shall soldier on. The show must go on. I do know that Matthew is a very provocative thinker. I do know that he mentioned that ESG is not necessarily the panacea that everybody wants it to be. And it's funny, he mentioned And the way that I look at it, and I know that Mira has promoted this all year, is that in many ways it's business as usual. So if you're running a great business, which I'm going to hear from Ghida shortly, of course, other factors over just financial reporting or statutory reporting are very, very important to all manner of people, be it your own employees, be it your customers, or indeed other stakeholders, including the all-important investment community. So Matthew's sort of thrown us a bit of a red rag, which I'm pleased to acknowledge, and I'm hoping that Ghida in her own role would just share with us, because I couldn't say enough about the retail fashion business that she's in. So I'm hoping she's just going to open with some remarks about what she does, what the business is like, and what she's been seeing, particularly in response perhaps to what Matthew was outlining from a broader perspective. Welcome, Ghida.
Hi, John. Hi, everyone, and thank you for having me on this panel. Well, I work for Fawaz Alhokair. Fawaz Alhokair was established back in 1990 by the three brothers, Fawaz, Salman, and Abdulaziz. And they've grown from then to become the leading franchise retailer in the kingdom and select strategic markets. Fawaz Alhokair is the only listed entity of its kind in the region. Most of the competitors, all the competitors, are privately held. And today we operate in fashion, retail, and in food F&B business. Our top line exceeds 5 billion Saudi riyals. For the past 2 years, the company has been going a turnaround in a turnaround story. And that's by itself is a messy sort of process. On top of that, we were hit by COVID. Discretionary consumer retail specifically was one of the sectors that was mostly affected by COVID. And the third, I would say, moving part in the challenging story was the dwindling or lower sort of disposable income given the hike in VAT, etc. So when I joined back in February of this year, the company was really in a challenging position because they didn't have an IR function. And I believe if anyone in the kingdom would sort of learn from Alhokair experience is the need to have a proper, fully established IR function, because that void that was created following these sort of challenging year for the company, for the sector itself, and not having a proper IR function and creating and suffering from this void between the management and the investment community has had repercussions on the company, which we are still dealing with, even as we go back to normalization. So if anything, this really stresses the importance of having a proper IR function fully established. What I see sometimes in the region is that you have the CFO also wearing the hat of an IR officer, or the head of strategy also wearing the hat of an IR officer. It can work for some time, I believe, but the eventuality of the matter is any company, whether it's a big cap, mid cap, or a small cap, and depending on the model that they want to sort of adopt, whether it's a hybrid, fully in-house, or they want to take, fully outsourced IR function, they need to establish an IR function by themselves. Now, this is even more important given, and again, this is something we touched upon yesterday, the importance of all the initiatives that the CMA, the regulator, and the Saudi exchange are taking to sort of push forward this function. As you know, in line with Vision 2030, in line with the ambitious targets of the kingdom, part of that is attracting foreign investors and foreign capital. And transparency, corporate governance, having a proper IR function, which really is the two sort of way communication channel between these investors and the management, is something to look for. I believe there's a huge opportunity for this function in the kingdom specifically. Now, if I want to touch upon the sort of trends that Matthew has mentioned, for MiFID, I believe in our part of the world, so the first layer for any specifically international investor is still to reach out for sell-side analysts. So for any mid-cap or big-cap listed entity in the kingdom specifically, you will see 8 to 12 sell-side analysts still covering the company. So the first layer continues to be these sell-side analysts, and therefore for any IRO in the kingdom or in the region, they have to have this open communication, proactive channel between themselves as IROs and those sell-side analysts, whether for regional, local, or international investment banks. For passive and retail investors or active investors, again, we are seeing increased participation from passive investors, but I believe as a percentage of total shareholders, it's still much, much lower than what Matthew or Michael see in the US and more developed markets. At least what I see as a concern or as an additional layer of complexity for IROs in the region is not active versus passive, but rather retail versus institutional. Because in our part of the world, again, and specifically I would say in the kingdom, you have a big chunk of your free float owned by retail. And I believe, again, this would require the disclosure or to have two sets of disclosure, because now you have two sets of audiences, the sort of sophisticated investor and the non-sophisticated investor. Again, I believe this is an additional layer for any IRO to consider. Again, on the ESG, whether you consider it a trend or a fad, it's really, I've heard the two opinions, let's put it that way. What is certain is that one, it's in an infancy in the region. What's more important for us today, I believe, is CSR. And again, this falls in line with sort of the Vision 2030 pillars, which is diversity, inclusion, empowerment of women, and the well-being of your employees and your team. For us today, and this is something we've seen post-COVID as well, we are one of the largest employers, and we pride that over 60% of our Saudi employees are women. And we sort of push forward for better CSR sort of governance in our entity. So I believe in the kingdom, the focus is more on CSR rather than ESG at this point in time. For the M&A, this is definitely an opportunity, but more so, again, as you know, there's a big pipeline of IPOs coming into the market, and we've seen already significant market activity. And I believe, again, the regulator and the Saudi exchange are adamant on increasing the breadth and the depth of the capital markets in the kingdom. And this is a great opportunity for IROs and for the function itself.
I think you are muted, sorry.
Again, thumbs up, Matty, if you can hear me. Good man, thank you. I was just saying what a wonderful response from Ghida on the ground there in the kingdom. And I like the way that you frame the discussion, in spite of what Matthew's, in his inimitable way, has tried to provoke. And in many ways, it isn't provocative because, as you said, actually you start from the basis of the business, the ground up, the way the business is run, who the important stakeholders are, and you address the strategic communications very much with that in mind. Let's just be interested, given the experience of the past 18 months for a retailer, which I'm sure, to use Matthew's word, although in a different context, an existential question. For retailers I know around the world, it's been particularly challenging and difficult. You also mentioned not just a retail brand or audience for the brands that you you sell, but also a heavy retail investor audience. And I'm just wondering, going back to strategic communications, how you prioritize those audiences and how you address a large retail audience in the kingdom.
What most important really is to have proper access to your share register and a proper analysis of that share register. Again, it's not, I wouldn't say you have access to the information, but doing the proper analysis can be a bit costly. Now, again, going back to IR 101 and sort of the basics of IR is when you, after you've done your share register analysis, is to have a very focused sort of targeting, an investor targeting. What is it that you're looking for? If you don't understand or you don't have access to who owns your stock, you won't be able to strategize accordingly. So in our case, we know exactly who our retail shareholders are. We know exactly who our institutional investors are. And we target both differently. So our disclosure, our market disclosure is addressed to the institutional investors. But then at the same time, we reach out to these retail investors. Typically, these are sort of big ticket retail investors. And again, at some point in time, you need to put a limitation, 20 top shareholders or 40 top shareholders. But it's very important. You might not get a response back from them. But what is important is that to reach out to these retail investors, because whether you like it or not, these are strategic investors for you as well. It is much easier to deal with institutional investors because you're speaking the same language, especially if the IRO is coming from a finance background, so you understand their language. It's easier for you to sort of disseminate the information in a language they understand vis-a-vis the retail investors that needs a little bit more tweaking, let's put it that way. So I think the basis is to really have a proper share register analysis and know exactly who owns your free float.
John, you are muted, sorry.
Maybe, Michael, we should go to your segment.
Guys, can you hear me? Okay, apologies. Audience, you can see that there are a few technical issues. So what I'll do is I'm going to quickly turn to Michael and go back to this word existential, because if you think of what Matthew said, again, in another context about artificial intelligence, about, in many ways, the automation, if not the digitalization of the whole investment process. Michael, you work in lots of emerging markets, including the ones that we're in. And I'd just like you to reflect on what both Matthew and Ghida said and share your own experiences, including in this part of the world. And I know you take tech far more seriously than I do, and perhaps you take it as seriously as it should be taken. Maybe that's a generational thing. And by the way, guys, if I get cut out, I'll use the chat to ask you questions. So please keep an eye on the chat as well. Good luck. Cheers, Michael.
Thank you very much, John. Thanks for the invite. You guys are doing, you and Lithia and the team are doing a fantastic job in Saudi, in the Middle East. I'm a little bit disconnected being in London, but every now and then in a certain meeting or someone brings up Middle East IR Society, I feel really fantastic for everything you're doing. And we all can't wait for the annual conference coming very, very soon. So we look forward to that. I guess kind of I'll just maybe talk about a couple of maybe lessons learned from the last 18 months or so. So I think with coronavirus, I think one thing that has changed a lot is the kind of the concept of virtual roadshows, which is basically able to speak to investors directly using calls such as this one. So this kind of on one side, it got a lot of people very excited because it basically meant that the friction of targeting and reaching out to investors in London, in New York, in different places. Before that, kind of investors really expected the face-to-face meetings. And we were suggesting virtual meetings, and everybody was like, it's a good idea. Let us know next time you're in London. So I think that, I would say kind of 90 to 95% of investor meetings were face-to-face. And it kind of switched off kind of overnight, that it's become a norm to be doing meetings using Zoom or basically kind of speaking online. So kind of on one side, a lot of companies started thinking, well, that's fantastic because we can now reach the entire world. So we have our shareholders to address, we have our peer holders to address. But if we want to send an invitation proactively to a fund manager in Chicago that we've never met, technically speaking, it should be doable. If we look at the global emerging market universe, we see that there are funds really all over the world, the concentrations being UK, Europe, and the US. But there are a lot of funds that are outside the traditional cities that we've kind of haven't been. So kind of a lot of people got very excited, and I think for a few months, I think that was very, very, very well. But then also, if we look at how investors, they also feel they have also been inundated with quite a lot of requests. And then at some point, kind of, you realize that you can take only kind of X amount of meetings per day. And then kind of the concept kind of started appearing is kind of how do we differentiate ourselves in a world of, so if we look at MSCI Emerging Market Index, there's about 4,000 investable companies that fit the mandate of liquidity and market cap that typical investors are able to invest. So then, and in the world where there is no friction to communicate, because we have the same toolkit as a company in Turkey, in Russia, in Poland, then actually that becomes that for an emerging market MSCI investor who's benchmarking to that performance in, let's say, Toronto, actually the question has become kind of how do we stand out and how do we become different to a Chinese company in exactly the same space and with the same fundamentals. And this maybe touches a little bit kind of to where we started thinking about MiFID, where the sell side analysts would create a story for us and they would package the story and they would sell that story very proactively. I know that in the Middle East, we still have quite a lot of sell side coverage. Probably most of the sell side is local, which is addressing the local mandates of investors. But I think if you are to reach an investor in Sydney with a very large emerging market fund, I think you start to question about, well, will the sell side pitch my story, or do I have to do things kind of myself? And I think actually it really was a fantastic opportunity for IR teams, because the role becomes a lot more strategic. You don't become a person who is sending out press releases and connecting the conference call before the earnings. Actually, your job is, how do I pitch my investment case so it's different to not my peers in Saudi and my peers in the Middle East, but how is my investment case different to a company in Turkey, a company in Poland, and two companies in Asia? And the reason is because we are thinking like the investor, and if we are thinking like the investor, we think about his mandate or her mandate, which is kind of top down. So 23 markets, sectors, and then my company's here, right? So I think that was kind of very, very exciting, because the IR teams across the world have started to think like, I am now the equity salesperson for my stock. So what lessons can I learn from the sell-side analysts? So I started going to, we started speaking to sell-side analysts. Yes, there's less and less of them, but they taught us some fantastic kind of, tips and tricks of how do you position your investment case to the investor. And of course, you have to be kind of a little bit, a little bit neutral as well, how you talk about your market, and it kind of can't be too salesy, because then people are going to kind of say, oh, this is too salesy. But I think that kind of opened up a whole new dimension for investor relations. And I remember, John, we always talked about the strategic role of IR, right? And actually, this is the moment for strategic role of IR, because we are now fully in control of our message, and we have a channel to reach the whole world. And that channel is, so we have an equal playing field, really, and that playing field has been created overnight. So I think that's one thing. So I mean, I think it's exciting. I'm not an IR person, but I'm very excited, like just looking at this, because it changes fundamentally the definition of the role of IR. And the second thing was, which was also super exciting, was that a lot of investors said, well, you know, with the roadshows, we often meet the CFO and the head of IR and the CFO, and it's great, fantastic, right? But with the virtual world, it gave the opportunity to go deeper inside the company. So companies started doing a roadshow with the head of digital, the head of this business line head, right? And this kind of we started thinking about it from a perspective that investors, they want to hear the updates, and the CFO, CEO, management, of course, the first meeting key. But actually, what is interesting is that we have the opportunity to give everybody, a lot of other people in the company, access to the investment case as well. So you can start with the local investors, and you can introduce them to somebody that they've never spoke with before. Then we started thinking about retail. So retail is very, very big in Middle East, but it was not very big in other parts of the world. It has become right now. So companies started saying, well, let's do quarterly calls for retail investors. And I really like Ghida, what you were saying, because you're already kind of thinking about it before, but companies started doing an earnings call for institutional investors and then an earnings call for retail investors. And the retail investor call was maybe a little bit more general. We were very surprised about the sophistication of retail investors. Some people really, really knew their case. And then we started saying, well, let's do a fireside chat with the sell side analyst. So the CEO and the sell side analyst, a fireside chat. So it's kind of like a Q&A kind of a thing. And then kind of once I had a call with a very large fund in Boston, and he said something which I think I'll never forget, which summarizes what I'm saying. And he said to me, we are long-term students of the company and the industries. And the IR calendar is our curriculum. So the IR calendar becomes a curriculum of studying the company and the industry. You want to make that curriculum interesting. I mean, we all went to universities, and we all want to learn about the subject from different dimensions. And I think if the IR calendar becomes the curriculum for investors, you realize that, wow, that's fantastic. So we have the quarterly earnings calls, great. Then we have an ESG call. Then maybe we have the head of retail, the head of digital doing a call. And actually, all of a sudden, you realize that if you're the investor, you go to them with a curriculum and you say, here is all the different events we're doing, and they're very tailored to you. So you can see that some are not for you, some are for you. Some of them you want to hop in, some of them, if you're an analyst, you're not. But effectively, that becomes very nicely put. And the good news actually is that the head of investor relations, so this mandate, everything that I'm saying, sits not within management, not within corporate secretary, it sits squarely within head of investor relations. So it's kind of like a fantastic opportunity. And so those were kind of probably the things that I would say changed the most in the last kind of 18 months. And there are some very good examples of companies, and I'm happy maybe to leave, maybe to send some links later on as a follow-up to different companies that have embraced this opportunity and have kind of said, well, we have about 3,000 institutional investors. Those are emerging market global funds, about 3,000 plus or minus. We are speaking to, let's say, 120 of them, the usual suspects, a lot of people call. So then the question is, how do I reach the remaining 3,000 investors? And yes, it will not happen overnight, but to do that, we need to think about differentiating ourselves. And I'm arguing that one way to differentiate yourself is basically through this approach of investor relations. And that's what we can do as an association. It's what we can do individually on the call. A lot of things are a little bit outside of our control. I know that there's a lot of management overlay into what we're doing, but I think what I'm talking about here, I think we're in 100% control over that, or maybe 90%, right? So those would be my kind of few things, John, to answer. And yeah, technology, I think it's, needless to say that you have to be using technology to reach those investors, to prioritize them, to target, to things like who's buying, who's selling. I mean, otherwise you're doing it manually, and we're all kind of super stretched, right? So I think I've always been a big fan of using tech to make my job more efficient. And I think what we are discussing here, I think technology can, make it super efficient.
Presumably you guys can hear me. Well, that's a relief. So, Michael, technology is required, and technology is thankfully working. I was just going to really pick up on Michael's point. I mean, we're talking here about strategic communications. You all know that strategy is essentially all about competing, if not winning, and it's about competing for attention, if not competing for capital. So I'm going to turn to Matthew, since he kicked off the conversation, very much talking about, I think, a segue into investor relations as a strategic resource to ensure that the investment story, as Michael said, is actually planned and reaching all the right targets. So Matthew, a question just come in, and thank you, audience, for the questions. Please make them or continue to make them come in through the chat. But essentially, talking about planning, Matthew, the question is that wonderful trade-off between good old long-term institutional investors who you want to stick with you and maintain a stable share register versus liquidity, retail investors, and getting the share price in good time, in terms of fair value, over time, in the right place. So my question, if I can get it out simply, is about the planning process, is about the competition for attention, if not capital. How would you respond to that very, very good question about that tension between the short-term liquidity-driven markets, particularly I think in emerging markets, versus, well, hang on, we should be talking about the long-term fair value, and we've already mentioned the big institutions that stick with us. I hope that's clear, Matthew, and I hope you got all that. Put your thumbs up if you heard me.
Yes, John, I got all of that. I'm just processing it all because you touched on quite a number of interesting themes there. Yeah, in terms of competing for investor interest, I am tempted to say, having dealt with hedge funds and the like myself for many years, fickle friends, and particularly the problem is whenever you're involved in a roadshow that an investment bank has organised, you can be sure that there will be plenty of hedge funds on the itinerary that the bank gives you, because they will be the bank's biggest trading customers and biggest sources of commission. So, you know, a word of advice I give any company that I advise is, let me have a look at the itinerary, because sometimes the people at the bank want you to meet are not necessarily the best long-term holders of your shares. I think that's what we should be doing in the IR community, is looking for the ideal shareholders rather than the fast money. And if there is a trade-off between finding the right buyers and finding people who are willing to inject a bit of liquidity into the shares, I think if I had to come down on one side of that debate, I would say go for the long-term guys. You know, liquidity will come in due course, but try and get BlackRock or Schroders or Lazard or Fidelity to buy the shares, because, you know, it might take 5 meetings, but once you get these guys on board, they'll be loyal shareholders and they will support subsequent capital raisings. Whereas the hedge funds might give you a little bit of liquidity today, but they'll be gone tomorrow. So that is my kind of rather unfair, but I may have overstated it, but that is how I would come down in terms of that trade-off. In terms of other challenges for getting noticed, yeah, just to go back to some of the other points I made earlier, I think, to reiterate the point that Ghida made, the sell side is still really important to engage. They amplify any message that you have. If you have one conversation with one sell side analyst, you know, she may repeat that to 10 other buy side institutions. So the sell side is still very important. You just need to be a bit more intelligent and tactical now in how you enlist them. I mean, a particular trick of mine, which I encourage my companies to do, is to try and present to the sales force at any big investment bank. Once you present to the salesman, and it's a very easy meeting to set up, you can do it over a sandwich or virtually. But if you impress the salesman at any big investment bank, they will probably bully the analyst there to writing another note on you, or to taking a deeper look, or maybe even covering you where they're not covering you. So if you can present to Salesforce, that would be my top tip on the sell side. In terms of my top tips on the buy side, as I said earlier, a lot of the big firms now are taking things in-house, and it's particularly important to know the people who are in charge of corporate access. And a BlackRock or a Wellington or a Lazard, they will have someone who is the gatekeeper to any fund manager, and your best bet is to know that person. That person can connect you with the right people, and even more importantly, going back to the active-passive debate, that person can tell you whether a holding is a genuine position held by conviction by some fund manager, or whether it's a passive holding. And that's particularly important when we're dealing with the likes of BlackRock, State Street, Norges, people like that, where you might see them on your register, and you might think that someone at BlackRock cares a lot about you, but they might not. It might be entirely passive. So you need to know the right people to speak to on the buy side. So yeah, those would be my 2 top tips for buy side and sell side.
Super, Matthew, and I'm assuming you can still hear me, guys, in which case, Matthew, put your thumbs up. Good man, thank you. Apologies, audience, again for this, but this is me rather than, it seems, the panel. And just picking up on Matthew's points there, clearly there is no shortcut, Ghida. There is no lack of need to plan and engage with the target audiences. And I'm just wondering from your own experience how you go about doing that, and how you, as was reflected in the question that I just got, essentially convince management that you know what you're doing on their behalf, and they can value your tremendous contribution to strategic communications. And if you have any key performance indicators that demonstrates that value to your management and board, please share those as well. Thank you, Ghida.
Thank you, John. To go back to what Matthew and Michael mentioned, look, again, it's the definition of the investor relation officer, and this is what needs to be sort of more better explained or in the region. It goes beyond having someone who can write a tadawul announcement and go to the market and announce what the company has done. It is really explaining to the management. And this is your first line of defense, again, because you can be the best IRO. And if you don't have the backing of your management and the board, then you will not be able to perform properly. So I think this is the first sort of hurdle. So you go there to the CEO, CFO, and the board, and you explain exactly to them where the investor relation department is value accretive, how you can enhance the visibility of your future cash flow generation, for how you as a function can increase this visibility, can increase the predictability. And this is exactly what the investment community is looking for. And whether you're having this sort of volatility and share price or not, the eventuality of the matter, this fair value gap, if you do your job properly, this fair value gap will close. And at the end of the day, you will create long-term strategic investors. You will create sustainable liquidity on your name, perhaps better access to debt as well. So I believe as a first step is to really define your job as an IRO within the entity you're working. And then again, look, and again, I take you to what we're doing. Equity investing is all about the growth story, right? And as Michael rightfully said, today, if I am going to go and compete for the capital, which is again dwindling, right? So I'm competing for this capital. I can't go and tell them, well, yeah, the CEO is talking about strategic sort of transformation with a set of pillars, but he's been talking about this for the past, for example, 2 years, and this is important. The financial performance of the company is important, but what I've noticed that these investors want to hear it from the horse's mouth. They want to hear it exactly from the people who are driving the growth. For a retail company like us, it's really the head of the business unit who are driving your revenue, who are driving your top line. And for example, we are preparing for a roadshow later in November, and I think for the first time, it's not going to only be the CEO and the CFO. We're introducing the head of e-commerce. Again, e-commerce is crucial in retail, and is creating this omni-channel experience for consumers, because at the end of the day, and this is something my boss shared with me today, for retailers, consumers are your boss because they choose where they spend their money, right? So on top of the head of e-commerce, we're bringing in the head of F&B, because again, this is the segment which is driving the growth. If you go and tell them, yeah, I'm going to generate XYZ in the future, and this is stemming from e-commerce and F&B, these investors would want to know exactly where is this growth coming from, what is the strategy, not as a consolidated level, but exactly on these segments, what are you trying to do in order to generate that growth? So again, you are the driver as an IRO, coming with these initiatives and coming from this perspective to drive the equity thesis within your investment community. It goes way farther than just writing an announcement, or more or less sharing or echoing what the CEO and CFO is doing. It's rather you at this point in time advising, after having listened to your investment community, advising back the management on how they should address the investment community concerns and how they need to tweak their approach. The old good ways, I don't think they will be effective going forward.
A great comment, and it sets Michael up nicely, because in many ways, Michael, I know every time I've heard you speak, you always emphasize the opportunity. I like the way you call it a level playing field. In many ways, that's what we've all experienced in the past 18 months, because we've just had to get on with it. We've had to adapt, even dinosaurs like myself. So I'm just thinking, Michael, from where you sit and what you pick up, if it is great opportunity for the would-be IRO, and I'm thinking of some of the newer teams, where do you begin? So you're sitting in the kingdom. As you said, actually, you should be looking beyond the kingdom, given your own share register. How do you start that? What are the easy wins for a new IRO?
So I think just listening and maybe echoing what Ghida said, right? So like maybe the first step is, am I speaking to my shareholders? Who are my shareholders? Like that's kind of like the basic fundamentals of it, right? And the typical thing that we do via our platform is we try to make sure that companies reach out for a meeting at least once a year to every shareholder. So I think that's a kind of like a very it sounds very easy, but then you'll be very surprised that actually most companies, I'm talking about here maybe the institutional side more, but actually probably the same thing applies to retail in a different format. But maybe the starting point would be, if I have 49 institutional investors that are investing in me, have I met all of them, or have I extended an invitation for a meeting to all of them once a year? So that kind of obviously involves having some kind of a CRM system, right, where you track the meeting when I met the investor. A lot of companies don't have that system, but it's a very, very basic thing. You can use really anything for that, right? I met Shua Capital in Dubai, 15th of September. It's there, and then you can sort and you can say, well, actually I have 20 investors I have not heard from. A very simple thing would be to send them a message and say, we are here for you, and we're doing a group meeting to bring you up to speed with everything, right? So I think that could be maybe kind of like a first pillar to take, let's say, and it's a very easy starting point. The second starting point could be, well, let's have a look at my peers, and the peers can be Saudi peers, but they can be Middle East peers. But I would also encourage to add a Turkish, Russian, Polish, Thai peer, because again, if we look how the investor thinks, he thinks top-down MSCI countries, and then he narrows it down. And then kind of, the very interesting question is, who's investing in my peers that has the mandate to invest in me as well. So you might have a Thai investor that invests in only one Thai stock, and the mandate is Thailand. So that is not relevant for you. But if it's a global asset manager, with a mandate to invest in global emerging market equities. And if you meet some kind of basic criteria like liquidity, rule of thumb, $1 million of trading per day, market cap threshold, rule of thumb, $1 billion of market cap. If you kind of meet those, let's say, kind of minimum requirements, you basically can go to most of them proactively, and you can say, well, we see that you are a global emerging market fund. We see based on public filings that you hold this and this. Here's how our story is different. Would you like to have a call, right? So this is kind of the concept of proactive IR, and that's probably kind of a second pillar. It takes a little bit more time, right? A little bit of kind of, but I think that's a great kind of two things. And coupled with an updated calendar. So if you have an updated calendar on the website with everything you're doing proactively and the basic kind of best practices of IR websites of what you should need. With those two things, I think you are covered, 60–70% of best practice IR. I think those, if we get those right, elements are, I think that's fantastic starting point, right? The second thing I just want to maybe just touch a little bit to Matthew's point about ETFs and passive investors. And I think I was trying to think this morning, John, what is our title of the conference going to be in 20 years time when we do the IR Society annual conference? And I was trying to think kind of like where things are going. And actually, it is true that the human element, the human emotional flawed element in the investment process is slowly moving away to the computer and the machine making investment decisions. And we are seeing that through well, passive investment. I think it's a kind of, we have two types. We have ETFs, right? And then we have quants, which again, we cannot kind of control. But on the other hand, how do we influence, or how can we, so for example, a typical exercise would be, let's look at all the passive funds that invest in Saudi today. So you will see that there's a number of them. It's still probably small compared to other markets like UK, Germany, but they can be broken down into ETFs like iShares, where it's a market capitalization weighted index. So kind of the question is, okay, so what should my market cap reach so I can be a constituent of the iShares emerging market index, right? So this is kind of like maybe this is kind of like a starting point which doesn't involve too much, but maybe the answer is my market cap should be $10 billion for me to join, let's say, be part of the ETF. So I'm thinking now, not in terms of how do I position my investment case, but I'm purely thinking about how can I be part of this passive. So this is a starting point, but then kind of the other things can be, you can go deeper and you can say, what is the kind of methodology of the quant funds? And it's extremely difficult to kind of crack, but you can, for example, look at, you can do kind of a reverse model, and you can actually look at the buying and selling behavior of a quant fund over a period of 3 to 5 years, and you can actually realize that, well, maybe there is something to do with dividend yields and valuation together. And then all of a sudden you are thinking about, well, what should my equity investment case look like fundamentally to qualify to be part of the machines, the robots that make the decisions for us. So I think that will be kind of a fascinating. I mean, I think we're super early there, but I think maybe in 5–10 years time, the discussion is going to be, well, the investment decision is mainly done by an algorithm. Let's face it. We as IR, we are the inputs to the algorithm. So the input is press release. The input is the financials. Of course, everybody reads that. Right now, the input is the corporate access meeting, which is, well, tell me something that the press release does not have. I want to go deeper into the company insight, right? So that's a meeting, right? But even this, I'm also seeing that the meetings are transcribed by investors. They take very, very good notes, and they try to put that into the context of, if I meet you, Ghida, 5 times and I ask you a difficult question, maybe your answer will not be what you say, but maybe your answer will be, do you take a sip of coffee after the answer? And maybe that sip of coffee will give me a little bit more about the answer rather than what you say, right? So this is kind of just like an example of, going a little bit deeper in terms of the investment. And probably, sadly, for us humans, probably the computers can do a slightly better job reading all those signals than we can, right? We are very emotional creatures, and actually, so So I think if we really kind of fast forward the industry 10 years from now, I think the debate will be very much about the investment methodologies of investors being driven by algorithms and computers. We are the inputs to that, right, to those models. And the question are, you know, what is the best way to influence a quant fund, right? I mean, we completely neglect that right now. It's kind of, oh, you know, we only focus on the active. Yes, but we are the input for the ETFs as well. If not us directly, our fundamentals that are speaking for itself, right? A lot of people talk about conference call content, right? So what words we use at different conference calls. So I think this is kind of this is exactly in the same bucket, and the idea is not to look at it individually, but just to look at the 10 transcripts of the calls and basically see, is the tone of the conference call positive or negative? So that tone tells you a little bit more about what's happening versus analyzing the numbers. So I mean, so this is also kind of super interesting, but maybe that will be something for you know, for the next 5 years for our industry, right? But to answer your question, John, I think getting the basics right, you know, I think there's a few things that if we do very well, all of us in the region, we have the opportunity to kind of to stand out, right? I mean, I think for markets such as Saudi Arabia, for example, we have the opportunity to you know, be the you know, the leading market for IR. So right, so what does that mean? Well, we talk about good IR, but maybe we can quantify it a little bit, right? So maybe we can say good investor relation means those 10 things and doing them consistently well across the entire industry, right? And one of them could be the things that I just kind of mentioned. Anybody can do that. You don't have to have a lot of resources for that. And if you do those well, then the investors will notice that. So yeah.
Super, Michael, always fascinating, and in many ways addressing your view of the future of IR. I'm conscious of the time, albeit we had a few stop-starts, so we've got another minute or two. And before I end with Ghida's key learning point for all you wonderful IROs in the kingdom, I'm going to ask Matthew just to take up the brave new world of IR and just share his concluding remarks on strategic communications. And I know, Matthew, as always, you and I never quite agree on the same thing, so I'm always delighted to hear your comments.
Yeah, in a way, John, I tend to think of investor relations as a subset of strategic communications. We at FTI Consulting advise companies on all aspects of their communications with the media, with the analysts, with the investors, with government. So that, in my mind, is strategic communications, and IR is just a particular, very interesting subset, an interesting slice of that particular pie. In terms of two takeaways from me, I would say two things. At the risk of sounding self-serving, I would say think about an investor audit or a perception study, which is because it's a lot easier to plan where you're going when you know where you start. A lot of companies, and we do many investor audits, you often will be stunned by what your current shareholders think. So that's a very good place to start. And my second piece of advice, not wishing to contradict Michael, because I'm sure that the virtual way of working, the hybrid way of working, will be with us forever now. But I also think, get out there, get on the road. If you as an IR officer are not going to leave your desk in Riyadh, you will be outcompeted by your competitor who's prepared to jump on a plane to Abu Dhabi or to London or to New York. Your competitor will be the one who gets the investment. So I think there are going to be no prizes for the companies who hibernate, and I think there will be points for people who are seen to get out there and start hustling once again, which is a part of the job. So those would be my two takeaways: have an investor audit and get on a plane.
Super, Matthew, and I can reiterate the importance of an audit, essentially a snapshot of what your key audiences currently think of you and what they really think of you, as opposed to what you think they think of you. So it's a wonderful KPI. Certainly, Matthew, when I was the IR at the Singapore Exchange, we ran an annual audit for over a decade, and it was quite amazing what we got initially, which we didn't like, but how we were able to change the perception over time. So invaluable. And Ghida, if you could leave us with a parting comment. You've been a wonderful participant, and we thank you very much for participating in the discussion.
Thank you, John, and thank you for inviting me. Well, basically, I'm just going to echo what Matthew have said, because more or less this is exactly what our starting point was. As soon as I joined back in February, and in order for you, I mean, to set the direction, you had to have to go into a deep dive of sort of and a due diligence of what the management currently stands, what has been out there, and do, if not the perception study at the get-go, but when you open that communication channel with the investment community, you can have a sort of an informal perception about what they believe about the management and the company. So you need to have an objective opinion, and based on that, you will be able to create and strategize accordingly. And then later on, and this is something that we've done after 8 months, we've recently closed our perception study. And yes, we've seen an incredible sort of improvement in the perception of the investment community versus us, but still it highlights some loopholes, which doesn't necessarily mean that you need to alter the entire strategy, but to tweak it here and there to better address what the investment community still believes as sort of shortfalls in the vision or the strategy of the management. I believe this is your starting point for any IRO. And again, I believe the Kingdom has a lot to offer for the Investor Relations Department as a function. And again, echoing what Matthew has said, and this is exactly what we've done. We don't take IR as the only strategic comm channel. It is under the umbrella of strategic communication, under which you have IR and corporate communication. This is something that I've heard from several IROs, is that in several large companies or large caps, mid caps, you have these two sort of channels working in silos, whereas the reality, and in order to amplify the message and to have this consistency in the message and synergize between the two, both of them need to be considered and looked at as under one single umbrella, which is strategic communication.
Super, Ghida. And Michael, it would be remiss of me not to give you one parting shot.
I mean, I would just probably, yeah, again say thanks, John, and maybe just encourage everyone to, you know, to join similar forums that are organized by MIRA, and also I know that Saudi Exchange is putting a lot of efforts into this space. They're treating investor relations extremely seriously, so I really commend you guys for all the work, and also John as well, obviously for everything. So maybe my parting remarks is that there's a lot to be learned together as a team and as a group throughout. So I think, yeah, just more of that, I think, and yeah, in person so much better than virtual. So maybe the next one we'll do in Riyadh.
I couldn't agree more. And talking about in person, I know Alicia will kick me if I don't mention that on the 25th of October, so next month, we're holding our annual MIRA conference and awards, which Matthew will be pleased to know includes ESG and IR. And of course, it's a big open welcome to all of you to get in touch if you're keen in joining us. Of course, I'm a big fan of in-person. That's why it's called Investor Relations. But we also accept in this day and age, it's also going to be virtual. So it's actually a hybrid event. And on that note, I just want to thank the Saudi Exchange, in particular, Layla and team, for bringing us all together. Michael, Ghida, Matthew, thank you so much for your time and your insight. Always spot on, and I'm sure much appreciated by the audience. And without you, audience, we couldn't have held today's wonderful discussion. So thank you so much. Over to you, Layla. Thank you.
Thank you, John. I'd just like to thank our esteemed guest speakers today, Michael, Ghida, and Matthew. It's been a pleasure having you with us hosting this webinar. It's been a thrilling conversation and you've been great, wonderful speakers. And for our audience out there, all of our issuers, if you happen to have any further questions for our speakers or for us, please do reach out at listing@saudiexchange.sa, and we'll be sure handling those questions and sharing them with our speakers to address any of your concerns. And again, thank you, John. It's been great holding these webinars with Mira, and we do look forward to attending that hybrid event you're hosting the end of this month, hopefully. Thank you all.